This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. My guest today is Jerry Parker. Jerry is one of the original turtle traders, trained by Richard Dennis and Bill Eckhart back in the day. He has a 40-year track record in the trend following world. That is quite an amazing run. Jerry's been on this podcast many times. He was episode 1000 and he was many other episodes that I forget, but he's been on this podcast a handful of times. Today we cover all kinds of territory, all kinds of nuance, interesting nuggets. Jerry is always a great conversation, and he is fast becoming one of the most popular trend following personalities out there. He's got a new podcast you can check out as well, and also a new ETF. So stay tuned in this episode for more information on that. Without any further delay from me, let's jump right into Jerry Parker. How's life?
Fantastic. Joined the Memorial Day weekend. Been nice up here. I'm in New York today. Back in Florida tomorrow night.
I got to commend you. Maybe I said this the last time we talked, but I think you've ramped it up even more from this rather shy guy that I met for the first time in the 1990s to now freaking media personality everywhere.
Well, everyone's doing a lot of this podcasting. It's so easy in Twitter Spaces and Clubhouse, but you have a big lead on all of us. And congratulations on your Mulvaney. That was fun.
Yeah, he's great.
I was halfway through listening to Robert Carver. He's pretty interesting as well.
I've done these wandering in the wilderness, non-trading episodes. Now I think, okay, I'm being pushed. I have to come back and do more trading episodes. I've come full circle, to be honest with you. I was thinking about this today. I've had some interesting guests from different walks of life that were right up there with some of the trading guests. But at the end of the day, the trading guests, you included, there's just something simple and real and natural and honest about the conversation. And that's rare with other guests, I find.
Yeah, you learn a lot from these traders too. I always tell people my favorite books are those Market Wizards, but just trader interviews. They're so much fun. And just let the trader or the smart person talk. You just learn so much.
Yeah, absolutely. I mean, you mentioned those two episodes most recently with Paul and Robert, and it's so easy. Except Paul's, I wish you could see some of the video. Maybe I'll ask him if I can share some of the clips. I would ask these long questions, and he would just be like, Joe Friday, no, yes. It was great. It was great. Hey, I got to share with you before we jump in. I had no UVA connection forever, but I finally have one now. My nephew is down there. He is finishing his freshman year on the football team.
Awesome.
Apparently, the real nickname is White Chocolate. He is a cornerback, apparently the only white chocolate cornerback in the ACC, and apparently the kid's the second fastest kid on the team. That's pretty funny. We'll see what happens.
That is amazing.
I don't think I could give credit to my sister. It must be my brother-in-law that gave him the wheels. So he got a pick 6 in the spring game. That's a big deal.
Gracious. So what are your plans? You visit every now and then.
I typically come in every year, usually around Christmas, but I'm probably going to try to come into Charlottesville. I'm thinking September.
Definitely. I gave up my football suite. That was a bummer. I had that suite for maybe 15, 20 years, but my kids don't go. They live in Richmond, and two of them live there. They don't want to go to football games, and I live in Florida. So I was averaging about one a year, but it's a great atmosphere. Great school, of course.
I don't think my nephew yet fully understands the numbers of traders associated with UVA. It's quite extensive.
Right.
If that's a career that he wants to pursue in the future, there's a lot of doors he can knock on.
One of the greatest events I ever went to was right after 2008. I may have told you this story. There was a panel discussion with Paul Jones, Julian Robertson, Lee Ainsley, and John Griffin. Paul was talking a little bit about the 200-day moving average and challenging those fundamental guys, Ainsley and Griffin. And then they were like, oh, yeah, we don't really pay much attention to that stuff. And Julian Robertson goes, whoa, wait a second. I think I've come around on this 200-day moving average trend stuff. And I was just like, we got to get up and leave right now. It's not going to get any better than that.
That collection of folks associated with Mr. Robertson, they've had some interesting swings over the years. A lot of money's been made, but it's an interesting cast of characters with a lot of different strategies. It's nothing like the commonality that you might find in trend following practitioners.
I mean, just think if we would have been welcomed with open arms. You lose money? That's okay. You're a smart guy. You're Julian Robertson. Here's more money. We had the exact opposite, fighting and clawing and scratching for everything, even though it was much more transparent, systematic, diversified, almost impossible to lose all your money, have a massive drawdown. Yeah, just two different ways the world treats people. Even today, that one guy, Chase Coleman, I mean, he's still managing billions and being respected. And it's kind of unfair, but it will certainly always, regardless, as it's so little to do with money and AUM, be so thankful that I answered a Richard Dennis ad versus Julian Robertson ad.
I'm so thankful I picked up a magazine ad 10 years after you picked up something and read about you. That's kind of how it goes, though. You know, I think that seems to be the way people keep learning from other people. They keep being inspired from other people. I think maybe that's part of the deal. You were just talking about things being unfair. I don't know that this is necessarily unfair, but I've noticed there's a recent article, I think it was recent, blaming trend followers for March of 2020 moves. And then there was, you posted, I saw recently, blaming trend followers, I guess most recently, somehow or another, because China is not recovering, it was trend followers' fault.
We are long stocks or short bonds, of course, because that's where the trend is. So it's easy to pick up our positions.
Do you interpret some of these articles? I mean, I've probably seen every trend following article since the late 80s. It seems like there's not many that I can recall that were any good. And they usually always didn't seem to understand trend following all that well. And they always seem to have this angle that they wanted to blame. Either trend following was dead, or if trend following was doing well, they were bad guys. It's kind of one or the other.
Funny you mentioned trend following is dead. You know, Moritz Seibert.
Yeah, he came on the show.
Yeah, he's a great guy. He started a new fund, and he named the fund after some bird that I can't even pronounce the bird, Takahi or something. Anyway, supposedly this bird was declared to be dead because nobody had seen it in a long time. And then all of a sudden they saw it. So it wasn't dead. So that's what he named his fund after a bird who everybody thought was dead. I thought that was pretty cool.
I asked a question kind of like that to Paul. He had a 4-year stretch there where it's basically like 1% a year or something. And his answer was just like, whatever, things happen. I don't know. It's the system.
Yeah, the one thing he said that was a little disturbing, Richard, he's on my Twitter Spaces, and he's one of my best friends. He's my second Richard. He's just a superstar guy. And he helped me kind of see a deeper level of trend following, listening to him. He's super good in math. And I asked him about this, but I didn't understand, and I didn't really understand or agree with Paul on this idea that eventually, if you just trade long enough, eventually trend followers, or him in particular, or all of us will eventually lose all of our money. We will eventually blow out. It's just a matter of time.
You think it was a little facetious or just trying to make a point? I don't know if he really believes that.
Yeah, I think he does, but I don't think he needs to explain it better. One of the things that Rich did when we first got there, they would say, what do you think the risk of ruin is? People try to come up with a low number, but they were like, no, that's way too high. 1% or 0.5% is way too high. You've got to make it way, way less than that. And they said the way we do it is when you get in these losing streaks, you reduce your positions and your leverage by twice as much as your drawdown. Remember that turtle rule? And there were some other money management ideas that don't get a lot of press, trade level calculations and things like that. You don't make your trade level calculation equal your assets under management, which was what everyone else does. But in 1983, we were told, no, you don't do that. There's a few little nuances that I think maybe people don't know about them. They could logically assume that, yeah, you could get into a huge losing streak, especially someone like Paul, who just uses such huge leverage.
You mentioned Paul Jones at a UVA panel that you were on years ago. If I recall correctly, I believe your other Rich Dennis, was his inspiration to get into trading.
Yeah, probably. I mean, it's amazing how so many people heard about Rich and loved Rich and instantly saw something special there. He was that type of guy, just incredibly friendly, nice, and smart.
So crazy that, at the age that you got going, because you're still a relatively young guy. And how many years have you been at trend following?
40 at the end of this year. Turtle program, December 83. 1984 was the first year. And I feel like I should have done a lot better. I knew almost everything I needed to know. Everybody's drifting towards or away from the ultimate truth. Would have been much better to. I have some relatives who don't know anything about math or trading, and they ask me, how do you trade? I show them how to trade. And the guys who don't know anything and no interest, they just always follow the rules. To some degree, the smarter you get, it becomes the enemy of just following the trend following rules.
I noticed on your Twitter too, you've added some adjectives to trend following plus nothing. I think if I'm quoting you correctly, I think it's religious, traditional, classic trend following plus nothing. What else can we add? Is there some more that we can add on to that?
Now, I take great pride in that Twitter bio there. All of these things that are up there, they are things I have copied from rude tweets. So one day someone said I was religious. So I put that on there. I've had to take things off. They limit the amount of stuff. Rob Carver is responsible for ideologically pure, meaningless labels. It's got to go up there. It's one of the greatest things ever. Another rude tweet was, Jerry trades Tinker Toy hobby level systems. It's got to be there. What's going to take that down? So I Googled Tinker Toy. I'm pretty sure as a kid I had Tinker Toys. I Googled the correct spelling. I just hope Elon lengthens that possibility so I can keep adding, because I've had to take some things down.
And the funny thing is if we listen to any of the voices from all different walks of life in our lifetime or before us, people like the physicist Richard Feynman or Steve Jobs of Apple, all you have to do is listen for a few minutes and all these guys say the same thing. Simplicity, not complication, simplicity, keep it simple.
Today's managed futures CTAs, they talk a big game. The next paragraph will be something about how it's not that simple. I think a lot of it is defending the incentive fee. Do you listen to Niels's podcast at all?
Sometimes. I think you're probably going to go to the most recent Brian Proctor one.
Yeah, Brian was pretty good. He did a whole series with the top CTAs that Andrew Beer replicates, that SocGen CTA index. It was really insightful. But Brian was a prime one. He would say, keep it simple, keep the variables low, and the parameters more or less constant. In the next 5 minutes, he would just go into this amazing complexity. So I don't know how they reconcile what they want to say versus their actual practice.
Let me get you to pull on this string for a second. So if someone sits down and they kind of write out a system, they write out a trend following system, it can be quite simple. I think the complexity becomes imagining what that simple system is able to do. There's a lot of complex philosophical thought put into a simple system. These simple systems are doing some very complex things. Is that a fair way to say it?
I think so. I haven't seen better performance than, I call it one entry, one exit stop loss. I haven't seen materially better performance. If they all had this amazing extra performance, I'd probably just keep my mouth shut. Why wouldn't I? Why would I keep bringing it up? But I haven't seen much of that. Managed futures evolved into certainly not letting profits run and being very interested in sharp and smoothing things out. That's a shame. And then we learned from Rich, but I think with us, we didn't come in with any baggage. There was no quants, PhDs. There were some smart guys there with bachelor's degrees, but we didn't have anything to glob on top of trend following. And the Europeans had all sorts of stuff. And then trend following needed to, we'll just decide how much trend following we'll let in, but we're certainly not getting rid of all of our maths and all of the stuff we've learned that makes us physicists, PhDs, scientists, quants, and the institutional clients. They just eat that stuff up.
Those first 10 years of track records out of a lot of the European CTAs, they were doing the same thing as guys over in the States, I suspect. I think, tell me if you see it differently, but I would hazard a guess as the AUM went up and time went on and the amount of money the firms made went up, that might have been where some of the marketing complexity came from.
Definitely. I think that's fair. And then defending the incentive fee, I think that's the big deal. We may not really agree with these things. We may obviously understand as much as Jerry does. It doesn't really move the needle much on performance, but we got to have this aura, this storyline about why people should pay 20% of the profits. I moved it the other day. I had as my pinned tweet this statement from one of the bigger CTAs that I kind of actually like. I can't think of his name, but it's a big firm. And Niels had him on, and he basically said on there, if you regress CTAs, 90% of what they do, it's all about trend following. Everything else doesn't even matter. 90% of what they do explains their returns is all trend following. I had that up there for 6 months. It was so beautiful. I loved it. That's from a firm who has all kinds of capability for research and coming up with more sophisticated ways.
There has been innumerable ways that people have tried to run from trend following. I can remember the book, and he's a nice guy. He was on my podcast, but okay, we have the quote, time series momentum, trend following. Then we have the cross-sectional momentum, relative strength. And then I said, well, where are all these cross-sectional momentum track records? I mean, I'll trust you, Mr. Person out there, but where are the track records? That was always the thing that struck me. Even when I first heard about you back in the day, it was like, okay, I could open up the Stark report and I could see Chesapeake Capital month by month, and I could compare that. Here's EMC Capital over here, and here's Eckhart over here. Here's Dunn over here, and here's John Henry. I always thought that was so useful. You could see, okay, these were trend following traders, but some of these other strategies sometimes get buried in the mystical waving of the hand.
Academia, the wonderful papers that they write. Cross-sectional has major problems, and I don't even know if people trade it, but that's an academic's attempt at trend. And one of the iterations, one of the improvements on it was you're long the top 5%, then you're short the bottom 5% based on trend or the past 12 months. And then for many different reasons, they would say, well, you have these crashes where the shorts rally and the longs go down a lot. One of their improvements was to add, well, we're not going to go long things if they're in a downtrend or short things if they're in an uptrend. So let's overlay it with time series. Yeah, no shit. I tell you what, if you just do the time series, you'd probably be a lot happier. But yeah, it has a lot of problems as far as sample size, I think.
Of course, a lot of people know about your start, and they know how much inspiration you got from your start, how much confidence you got from your start, a very unique start. But here you are getting ready to start the 5th decade of doing this. What is the motivation? I mean, you don't have to do this. You've got a few extra pennies in the bank. You can kind of just chill and go to Super Bowls and stuff like that and hang out. You don't have to do all this. You've got a certain energy about trend following right now. I think even more so, and maybe it's just because you've gotten used to it and you like it and you enjoy it, but you're becoming a trend following personality for sure, 100%.
Well, obviously it's fun, and that's pretty much what motivates me. It's really fun. I have a great life. I have a great day every day. I find it almost impossible to do things that I don't enjoy. I had to write 2 forwards to 2 books, and I had months. These guys in Brazil wanted to translate a book, and they wanted to translate it into Portuguese. And they asked me to write the forward, and then another guy wrote a book following the trend, Clano. He asked me to write the forward, and I had months to prepare for this. And I just was paralyzed because I don't want to write it. I said yes, but I didn't want to write it. And so I find that that's the problem with me, is that I'll get up early to prepare for this, but then just something even minor, it's not going to be that much fun. I had to force myself to do it, and meet the deadline by 5 minutes. So it's just really sad.
You mean for the podcast or the writing?
The writing.
But podcast is easy now. You can just turn it on and go. That's just fun. Say for me, it's like you just get a chance to talk with people. We've all gotten more isolated as time goes on. So it's just fun to talk with people, you know?
Yeah, Reminiscences of a Stock Operator. That's what I wrote, translated into Portuguese.
The most famous book on trend following that probably doesn't say trend following in the book, I'm guessing.
Yeah. And I know Rich was kind of down on that book, and he was down on the guy because he committed suicide and stuff. He's like, how good of a trader could he be if he didn't survive? And survival is like the most important thing. You got to survive for 50 years and not blow up and keep it together. So he didn't really like that book or that guy. And I thought it was kind of interesting, but I've never read a book, maybe except yours, of course. Someone sent me something from your website yesterday of Dodgen. And with all due respect for all these people, I've never read a book where they had it all correct. And I was like, no, you can't do that. They have it wrong. I would change my mind in a heartbeat and I would give them credit. I'm like, oh, yeah, Rich got that wrong. This guy kind of got it more right. Because I'm long, long gone from needing to defend Richard Dennis, for God's sakes. But no one had it together in a complete package like Rich and Bill.
I tell you, it still strikes me, being in Asia, that particular book of mine is the book that people gravitate to. And part of it has to do with the Asian cultural perspective on turtles. There's something that's completely unrelated to the nickname with them not even knowing about it, whereas there's just something fascinating to the word turtle. And then secondarily, they find out about the story.
That turtle nickname is pretty cool. I think it worked out really well. Another thing that pisses me off and keeps me motivated.
Hold on. I like that line. Hold on. Another thing that pisses me off that keeps me motivated. I've got a list of these today, Mike. I got like 10 of them.
I have a list every day. It's not just today. But one of the things I found in my older age, but I don't think it's necessarily just old age, is I don't really enjoy sports any longer because I hate for my teams to lose. It's just like the markets. I hate to take a loss and winning the championship. My teams have won some championships recently, and I have enjoyed that, but just them losing just sends me in a tizzy. So I find myself rooting against teams. I'm following these teams that I really dislike, hoping that they'll screw up. And that kind of motivates me. Like the Lakers, I can't stand LeBron or listening to him and his attitude. So I just like follow some of these guys and I'm rooting against them, not for them. So it's kind of sad. But I keep telling myself I need to focus on movies and TVs and get away from sports. It's just too nerve-wracking.
I relate to it in the sense that I started to grow away from sports too in the last 20 years. And I think it really started for me once the Redskins got a new owner. Pretty much after 20 years of that, I was finished with all sports.
I know, especially the NFL. That was such a shame because we were huge fans my whole life. My son is as well. But maybe they'll turn it around now.
Let me bring something up with you guys. It was a tweet I caught on your Twitter thread, and you're so easy to prepare for. I can just find out what you're interested in. I think you were quoting somebody, and I'm paraphrasing a little bit here, but it was something to the effect that trend followers' year can be made by anything. And they were quoting, it could be rough rice, oats, OJ, T-bonds, NASDAQ 100, crude. For a guy like you who likes to get down to the nitty gritty, I'm not trying to put words in your mouth, but maybe you don't think that's such an important thing. But I still think that this concept of my year can be made by anything is a fascinating concept. I think I could sit there for like hours and try to explain to somebody this idea. Even smart people, they just kind of glaze over. There's something about the idea that you are agnostic to where the profits come from. Like there's an emotional attachment. I must get my profits from XYZ. And then if you tell people, well, I don't care where the profits come from, it's kind of like they almost think I'm playing with them or I'm stupid or something.
That's right. And it could come from anywhere. We're bombarded all the time by stocks are superior. Stocks are the core. Stocks have the better trends. And I don't believe any of that. So there will be, every now and then a certain sector that has the best performance, and it could be for a long period of time. And stocks that had their day in the sun probably, and they're still great. I trade a lot of them. And so I'm always very happy. I'm never rooting against stocks or trends in any market, but it is true that if you're hunting outliers, as trend following kind of does, you can get that big, huge outlier from anything. And it can be in a related market and in a sector. And the interest rate moves last year, it was just a big sector move mostly. The short-term interest rates may have gone a lot further than some of their other ones. I think that's been a big change in CTAs as well, the managed futures CTAs. It is almost all about the sector move, not about orange juice or not about Tesla or some big, huge monster trade that where it can come from anywhere. It doesn't come from anywhere. It comes from the group, which is much different than classic trend following. There's been times where heating oil doubled and crude sat there. You just let the profit go and they're highly correlated. They went back to being correlated. But for a short period there, you can get a big outlier from a market that you think, well, it's heavily correlated to a handful of other markets. So why trade them all? And take that in consideration. So trade it small. It's such a mistake. I remember Brian Proctor made a fortune on that silver trade when silver doubled in 87 and gold kind of sat there. But with managed futures, it's evolved into volatility management. We've got to tamp it down. If we get a big outlier and its correlation goes up and volatility goes up, this is a problem. A problem? Wait a second. Yeah. So it's turned from, it used to be what we're hoping for and banking on, the 5% of the trades that are going to have this outlier performance, to no, they are problematic. And we need to tamp down the yen short, tamp down the British pound short, and make them look like the other currencies because they're getting a little crazy here. And the vol that we measured at entry is much higher now. And this is causing extra risk. I used to really dislike this term managed futures, and I wanted to get rid of managed futures. Who the hell am I to get rid of anything? But now I love it because it's a very good label. This is what the vast majority of people do. It's not so much letting profits run anymore. It's Sharpie and volatility equals risk. And then just a handful of Chesapeake, Mulvaney, Moritz, Richard, four of us basically who let profits truly run without regard to volatility.
Let me keep it at the phrase that you just used, hunting outliers. I think that came from your trend following posse that you hang with. I don't think I've seen that term until the last handful of years or year. Was that your group responsible for putting that out there?
Definitely Richard Brennan. I think he gets that credit for that. He's obsessed with this, and he kind of helped me see at a deeper level, which makes it more fun to understand this simple topic and see how deep you can go and understand what's going on in the world and the markets. He sort of coined that phrase.
I had a reporter on recently, this guy, Scott Patterson, and he's written a new book called Chaos Kings. And he's talking about Mark Spitznagel's strategy in there, which described to me is very similar, hunting outliers, but I think it's executed in an entirely different way than trend following.
Yeah, I don't know too much about it. I read everything that I can get my hands on about him and what he says. It's a little bit about outliers for sure, but he doesn't love trend followers. I'm not really sure what they're doing. I read a lot of pros and cons about that particular strategy.
Yeah, some of it came up on the episode. When you use the phrase hunting outliers, okay, let's assume there's some people listening and they instantly get what hunting outliers means. Put your Bill Eckhart teaching cap on to 1983. Let's say he was using the term hunting outliers. Start to explain that to the average person that maybe has not heard that term.
Yeah, it's pretty simple. I mean, you want to trade all these markets, long and short, lots of diversification, currencies, commodities, stocks, and bonds. And then when you do a back test with straightforward trend following strategy, you'll see that if you let the profits run and don't get out of them before the trend turns, about 5% of your trades will be responsible for all of the profit, and everything else is kind of a small plus or minus. And that's historically been trend following. You're preserving your capital, taking these small losses. You're sort of separating, from the very beginning, the cliche says, take small losses, let profits run. It's making this distinction between, is it a profit? Okay, then I know what to do. Let it run. Is it a loss? Okay, I know what to do. Don't let it get to be too big. And then sometimes profits turn into losses, and the losses turn into profits. You're supposed to let that profit run. The computer tells you, oh yeah, if you let that thing run and don't scale it back based upon a profit objective or a correlation increase or a volatility increase, you'll make more money, but you will have some more open trade volatility. So we feel like that's a pretty good trade-off. And using something like Sharp or volatility as a measurement of risk is not really accurate. But clients don't really like it. They don't like these outliers. They cause problems. And so let's just scale it back and let's stick with the trend, but maybe we have half the position or a quarter of the position now because the volatility has gotten so high. They sell this as there's no downside to this. There's no opportunity cost. It's a freebie. Risk cannot be eliminated. It can only be transferred. Well, not in this situation. They've convinced themselves and their clients that you don't have to eat your broccoli.
Something that you were chatting on your Twitter, this idea that maybe they wrap their arms around trend following, let your profits run. And then they have to have that wake up moment where it's like, hold on, I let my profits run, but I could lose all of the profits on that particular trade in that particular market. Like I could run it all the way up and it could run all the way back down. I might have to give everything back. And I think the smart people out there say, well, hold on, there's a way that I can fix that. Why don't you give your best explanation as to why fixing that changes the trend following golden goose, which is sometimes you got to live with that.
I think one of the things that a systematic approach like trend following offers is if you run a reasonably robust back test, I like the one entry, one exit, one stop loss idea. And then you have multiple of those different entries, exits, and stop losses. It promises you that you'll make money over time. 40-year career or whatever, you'll do fine. This is what we take away from that is we got a lot of trades to look at over our career, over a long period of time. We're going to do the best. But what it doesn't say anything is about this particular trade today. I mean, what's more important than this trade right now? I can tell you nothing. There's nothing more important. This month, this year, relative performance, I got to beat so-and-so. I can't bear. Now, they want to blame it on the client. Oh, well, clients can't put up with that. Traders who cut profit short, come on. Don't blame it all on your poor client. You love it. You would do it if you didn't have any clients. I think you just make less money. And obviously, the downside, where did that risk go that you've taken it off the open trade equity where you could most kind of afford it? You put it into bigger losses. If you're going to have smaller profits and you're not going to let them run in order to make the same amount of money as someone who does, you just got to trade a bit bigger. And so rather than losing 25 basis points per trade, maybe you lose 30. Obviously, that's where it is. You have a systematic approach that has 40% winning trades. That doesn't sound too good, honestly. I don't like it. Now you've increased the size of the loss. But systematic trading is built upon this whole idea of as you add more markets and as you get better systems and your risk goes down, you can trade larger. So you trade a bit larger because your Sharpe ratio is better, even though I've already said I don't think that's a very good measurement. So you're building this house of cards where your sample size has been impacted. You're taking larger losses. You're shifting that risk from open trade equity to your capital. That doesn't sound too good. So that's where that risk goes. And the clients can't see it. Mulvaney's open trade equity fluctuate and have these huge swings, even though he's still up 20, 30, 40, 50% for the year. But underneath the hood, you don't see this incremental large. Every time we take a loss, it's a little bit larger. We're paying for that smoothness by having to trade larger and leverage up a shakier system. Doesn't sound like a good trade-off to me.
Let me push back on something that you just said. 40% losses as a trend following trader. You said you don't like it. Why don't you clarify that a little bit? Because your entire life has been off these kinds of losses. Actually, 60%, I think was what you meant to say.
40% winners, 60% losers. Sorry.
Your whole trading career, this fantastic life has been based off 60% losers. So when you say you don't like it, I don't know, do you really mean that?
I think it's okay to admit things you don't like, small little characteristics that you wish were different. But I certainly love that particular strategy that has 60% losers and 5% of the trades make all the money. I love the overall systematic approach and my systems and my drawdowns and everything about it. But yeah, we can all admit that, boy, wouldn't it be nicer if it was higher? Human beings love to take a profit and to get that pat on the back from yourself, even when just a one tick profit. One of the funniest things was Rich would always say he got into the business and he just spent a lot of years proving these cliches wrong. You can't go broke taking a profit. You've heard of this thing where you move your stop up to break even. At some point, you have a profit, so just move the stop up to break even. And of course, the computer will laugh at you and say, oh my gosh, that's really a bad thing to do. But that's just a common sense human thing. And common sense human things don't usually work very well in trading.
I don't know if I told you this before, but you should grab one too. I'm sure you could find it on eBay. But I picked up one of the original copies. I think it was from the New York Times Magazine, the first review of him back in the day, like 1976, I think it was. Just fascinating to see that. And I mean, his attitude, it was just so like, hey, here I am. Take me as I am. This is what I do. I'm not trying to impress you. I don't know. Maybe some people don't like that. I'm one of the types of people, if I see that kind of attitude from somebody, I love that kind of attitude.
These guys had great personalities. They're great humans, but they are super smart, man. I'm telling you. Because when they walk into a room, it doesn't take much conversation to realize you're in the room with some special people. I was like overwhelmed by just how smart they are. I'd never seen anything like this before. That's why it rubs me the wrong way, because a lot of times I'll read an article and they'll say, we started our firm and we brought in math and science and computers to take over for the people who were in the pit, codified their pit rules, and taught it to a bunch of turtles. It couldn't be further from the truth. We were on day one dealing with the smartest people as it related to trend following and systematic trading and computers and programming, and they fully equipped us to survive for the rest of our life. And I think some people have been able to do that. I would tell you if I would say like, oh yeah, I went to this seminar, I heard this person, they were really reminding me of Rich and Bill. Yeah, I'm still waiting on that.
I don't know if you knew him, but I think Bill Dunn was right there in the same headspace.
Yeah, I had one cab ride with him and I really like him, but I don't know any of the details of how he actually trades.
Give me a contrast. Here you are 40 years into this. Now, of course, you're going to know a lot more about the machinery today, about every detail than you would have known at, let's say, age 25 or something. But how has your psychology evolved from, let's say, the first 4 years of being a turtle to the last 5 years? Has there been an evolution, or have you just found a way to keep yourself consistent? How has that moved over the decades?
I was always a person who wanted to get deep, deep, deep into the philosophy. So as the specifics would change over time and the things change, markets change, the world changes, I'd still be able to have this bedrock set of principles. And we were just given bedrock set of principles. They were not going to really change other than.
But what about you? Did you change at all? Or did you have this early philosophical understanding and you've just built other systems to keep your system in place, so to speak, your personal system?
I don't read the Bible, but I hear people say, I've been reading the Bible, the same chapters or verses my whole life, and it's now I understand them so much better. And I think it's the same with me. I mean, I just think about this stuff, it ruminates in my head, I live life, and it gets deeper and deeper, and I understand it better and better. And I just keep going back to the original transcripts, what we learned and what they taught us. And I feel like I have almost a photographic memory of what they were telling us and what was important and what they said and interactions. So I strayed away and got punished and had to come back to what they had taught. I think I've made a couple of minor improvements. We certainly trade longer term than we did back then. When I left there, I was taught systematic trend following and how to keep it going for the rest of your life. And I thought this was the greatest thing ever. But I think over the past 5 or 10 years, I realized that they didn't really care about trend following maybe as much as I did. They were more focused on systematic trading. And they have no intention of trading anything similar to what they taught us now. Whereas I left there thinking we're all kumbaya trend followers. I was wrong. We were all systematic traders. And as you interview other turtles or you talk to them, they are doing things way different, let's say, than what they taught us. So I was really the one who misinterpreted that because I wanted to. I fell in love with trend following before I met them. And that love has only grown deeper every day of my life and how wonderful it is in every way. That's one of the things that motivates me with this new ETF we're coming out with. It's going to be 50% single stock. So I am not a managed futures person. I put trend following above everything, and I want to make it as good as it possibly can be before I depart. And that's my sole goal, is elevate trend following into what it could become and should become, not managed futures.
Tell me about your ETF.
Like I said, it's going to be the perfect portfolio, not the perfect hedge. One of our friends sent me an email 5 or 10 years ago, and the title of it was some marketing email, like the perfect hedge. I called him up and I'm like, you don't agree with this, do you? He goes, no. Yeah, it's not the perfect hedge. It's the perfect portfolio. So in order to have a perfect portfolio, we've got to have a lot of commodities, currencies, and interest rates, long and short, trend following, and a lot of single stocks. There's so many to choose from. It deserves quite a material part of the portfolio. And rather than allocating 5 or 10% of your portfolio to CTAs and trend following to help out with crisis alpha, let's trade our stocks with trend following so we'll maybe have fewer crises to begin with. Obviously, this is something that should have been offered to clients years and years ago, because the CTAs themselves are not going to advocate for taking arguably the most important part of the portfolio and wrapping trend following around it, this wonderful strategy that preserves your capital and makes a really decent return. Who is? And I think that's what essentially has happened, is that managed futures knows its place. It has its little place. No one wants to upset the apple cart, trade those indices, give me the 5 or 10%. It's like the Stockholm syndrome. We're kind of siding with our captors.
As you keep using managed futures essentially as a pejorative, I assume from the Jerry perspective, there is managed futures over here, and then there is a handful of people that we can discern are pure religious zealot trend following traders over here.
That's right. But also remember, the only reason we believe that is because of the back test and the numbers that prove we are correct, that the best way to manage money is to let those profits run. I mean, there's other components to what we do, but that's the fault line. To what degree do you let profits run and have some volatility and give back some profits? And that's what's been missed. That's where managed futures took a wrong turn. The other day, I tweeted something, or I was talking to people about listening to Buffett and Munger and all these investments they have and all of the wealth they've created. And I said, do you think they've all managed? They got this stock that they're making a fortune on. And one of them walks in and says, hey, the volatility is really high. Let's get out of this thing. It's the silliest thing on the planet. Plus, the numbers don't back it up.
Everyone shows up to Omaha to salute these 200-year-old stock pickers who have a very narrow portfolio. And I think their portfolio is half Apple now. And essentially, it's just big concentrated bets looking for big home run trades. But it's apparently not legal in the trend following world to have such a thing.
Yeah, too much volatility is a problem. Clients don't like it. You can't raise money that way. Well, we'll see what happens. We're going to come out with this pure trend following strategy that trades 300 markets, and it's going to have a fair amount of stocks in there to get the potential outliers and to participate. We don't want to go through another 10-year period of a lost decade for trend following, primarily probably because CTAs weren't long the best trending sector, which was the stocks. And these indices, you don't get much of a chance to get a big outlier. So we're not going to let that happen again. And we'll see a fair representation of what trend following can do when we give it all the advantages of those single stocks, long and short. We have lots of shorts on now, lots of longs, just like we do in the other sectors.
They're just additional streams of numbers to trade.
So much fun researching and finding unique companies that do lithium, uranium, steel, eggs, French fries. So much fun.
But those are the names. You don't necessarily care what the names are. I mean, you could trade them without knowing the names.
But I do think that I want to have lots of diversification, give myself a decent chance. I mean, it's not like I don't want diversification. It's not like I embrace volatility and I just say the hell with it. No, I want to have a lot of longs and shorts and a lot of diversification in those sectors. And I want to try to smooth it out, but in a robust way that I'm not compromising with changing my rules and adding things to trend following that may introduce some negative skew. It's all positive. It's all putting your fate totally in letting profits run and taking small losses.
Let me ask you one last question, Jerry, before I let you escape, unless you don't want to escape, unless you want to just keep picking you for questions here. I was thinking this is something also from your Twitter, and I'm just kind of paraphrasing a little, but it was something to the effect of talking about when markets move, the source of trend following profits, people ultimately buying and selling markets, and the fact that humans have not evolved very much. I would love for you to kind of clarify a little bit there, but then I started thinking about that. It's like, not only have humans not evolved very much, but there's not enough time in life right now to get there, so to speak. So it seems like maybe by the time generations get to a certain point where they might be open to or finally understanding trend following after going through 20, 30, 40 years of Wall Street just feeding them whatever storyline they're fed, but then life is over. I think that's one of the disadvantages in that there's not enough time maybe to get to the trend following understanding when you have to go through the Wall Street minefield selling you everything under the sun.
Yeah, that's a good point. I feel like, though, I read about trend following when I was in my early 20s. I understood it. I loved it. I embraced it. Longs and shorts, of course, that's got to be better. Small losses. Look, the profit's going to pay for the small losses. I love it. I love the objectivity, adding more markets, currencies, commodities. Sure, why not? I've never been a fan of we got to educate people better. People can't understand it. I understood it. Anybody can understand it. I think what motivates people is politics and money. So it's not politically acceptable to allocate all your assets to trend following. I'm smiling. Of course it's not. I mean, it is for me, but it's not for anyone else.
So you were an outlier who trades outliers.
Yeah. People are greedy. And when I got into the business, we were making money and people were throwing money at us. And I think when we try to refine this strategy and make it as all it can be and give it all the advantages, primarily trading these stocks and as many other markets as possible, I think people will see this performance and they'll just be greedy. And you'll call them up. They'll call you up and say, I'm going to give you a lot of money. And you'll say, well, last week you said you didn't want to give me any money. Well, look how well you're doing. So miraculously, born again believers because it's doing too well.
I got to ask you, since you just brought something up and it just struck me that, okay, back in the day when the Turtle program ended, for whatever reason, I'm sure there's a lot of reasons, your particular company, Chesapeake Capital, really took off in terms of performance and AUM. And it was very mysterious at the time because it was still a lot of people really didn't have a handle. I mean, behind the scenes, people knew, but the general public didn't have a handle on what the quote turtles were doing. That must have just been so crazy exciting.
So exciting. It was so much fun. We probably made money the first 10 years. And that's what these sort of systems will do. One entry, one exit, and a stop loss. They're very consistent. So their hit rate per year of the trailing 12-month return, positive return, is so high. And that's sort of what they're able to do. You're letting these profits run. They're sloshing around. It's so much volatility. And yet they're very consistent. People find that hard to understand. We do these back tests all the time. And it's just like, it's really hard for this type of strategy to have a losing year. Now, some of the years may be 0.5% or whatever, but they're very consistent. Chesapeake makes money almost every year. And people love that. I remember walking around Manhattan and going up to a payphone trying to get a meeting with the guy who ran Merrill Lynch Managed Futures. I called, someone picked the phone up. I said, oh, this is Jerry Parker. Can I speak to so-and-so? I'm at Chesapeake Capital. And she says, hold on. And she goes, no, he cannot talk to you. And then I said, oh, tell him I'm a turtle. And then she comes back and she's laughing. And she goes, yeah, come on up. Having that track record, that 4-year track record was so important. I mean, you've got something to show people.
To add something, though, too, not only do you have the 4-year track record, so that's one period of your life, but then, and correct me if my numbers or my dates are wrong, but I think once you got into Chesapeake Capital for 3, 4, 5 years, then 1993 was like the year of you just going to the moon, right? Was it 93, I think?
Yeah, that was a really good year, plus 60%. Everything was working. Everything was great. We had it together. But I was not immune to trying to make it even better. So let's try to make it even better. Let's get rid of these drawdowns. And I think that's sort of what I was saying earlier. I have gone off the straight and narrow path because you're making money. You want to improve. How are we going to improve? Well, let's get rid of volatility. Let's get rid of losing periods. And so that's where you get in trouble and you start killing the golden goose, which then you have to revert back. And I remember one year we really over optimized our systems, and the first 3 months of the year looked so different from the 25-year back test. We were just like, oh my God, we've never even seen 3 months like this with these stupid systems. So we're like, this is dumb. We got to go back to our roots and trade the way that we used to trade, where we had all kinds of blemishes and faults, but we made money almost every year. We know what success for us looks like. And so I turned the page back. And I remember that same year, there was another CTA who had really suboptimal performance. And they started this monthly newsletter, almost saying the exact same things that I said. But their conclusion was, we're going to double down on the research and come up with even more complex, better systems. We're not going to revert back to what's got us where we are. And I was just like, okay, this is just who I am and my personality. I was given this incredible gift of knowledge and trading, and I got away from it. And it's okay. I'll be perfectly fine in my career just having to give 99% of the credit to Richard Dennis and Bill Eckhart. I just want to be successful. But we all stray. It's just, how soon are you to get back to what you know used to be a safer path?
I think it's one of the nice things you just do right there is you always express loyalty. You're always humble. And then you're being very honest about the ups and downs and mistakes. And so, heck, even if people weren't interested in trading, I would implore people to take a lesson from that idea, that if you do get a chance where someone shares something with you, and a lot of people have shared a lot of things with me, and I try to make those people look good too, because they've shared a hell of a lot of information with me. But being loyal to those people that you might meet early in life is terribly important, regardless of what one does in their career. If someone's good to you, I mean, I think karma's real. If they're good to you, it comes around.
Right. They were so good. And it's easy for me to be the one person that is going to try to carry it forward with as close to what we were taught as possible. Yeah, one person should just try it. And it's easy for me because I really believe it. It was a great experience. One of the things I've said before is that you can hand someone a manual and say, go be a Marine. But look, man, if you get that manual, plus you get 4 or 5 years in boot camp and men and women training you how to do the job, it's so much better. We would have been so much better off if we would have had 8 years or 12 years with those guys, just formulating and starting your career. And the bottom line being told, do the right thing, follow these rules. If you lose money, it's okay. And when we did lose money, they gave us more money to manage and just said, hey, you're doing the right thing. Don't get down. Just follow your rules. That's just not a real world experience. When you're out in the real world, clients are like, look, if you have to break your rules to make me money, you just go ahead and break them. I don't care. And get out of that trade. Don't get back all that profit. So just having those years with them combined with the superior knowledge and training we got, where would we be with another 4 years or a total of 12 years? How much better we would have all been.
Remember, Jerry, though, as you describe it, this was a terribly unique situation. There was not too many of you. This was not something that was done a lot in the 20th century. It was a pretty unique thing. Hey, listen, you brought up the new ETF, but where can people go? What should they know about it?
Well, thank you. The ETF symbol is TFPN, trend following plus nothing. The name is something like Blueprint Chesapeake Trend Following Strategy. It won't be hard to find. Won't be hard to find Chesapeake Capital, Blueprint Asset Management. Yeah, I think it's going to be quite a fun project and looking forward to being in that business.
One last thought here. You said to me before we started, hey, are we going to do anything with this video? I think we both look pretty good in this video. I think we should use some of these clips. We can find a couple clips in here. Yeah.
I love these videos.
I thought maybe you were going to show up, I don't know, hair sticking straight up or something. You look fine.
Well, it would be sticking straight up if it was longer, but yeah, it doesn't look too bad. But yeah, no, I agree. I think putting this out on YouTube would be really good.
We got some nuggets.
I need people to see that when I'm saying some of this stuff, I'm actually laughing. So when I get all uptight about what I believe in, I'm really not too serious about it all. But yeah, thanks for having me, Michael.
Yeah, cool stuff. Hey, anytime. In fact, I was thinking to myself, gosh, we did episode 1000. It's like, where's time fly? But hey, anytime, sir. Thank you.
Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.